Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is February 8th, 2023. I'm going to cover my market insights. I'm going to give you the dashboard indicators and the charts, and my comments about what I see going on in the market. We'll begin with the dashboard. This is a very positive outlook on the market. The green dots to the right indicate that the various indexes listed on the left are above their 20, 50, 100, and 200-day moving averages. And the red dots indicate that they're below those averages. But with the exception of the 20-year government bond and the emerging markets, they're all green. So, a very positive report. The set of numbers in the center show the percentage gain or loss for the week and the percentage gain in the next column, the percentage gain for the year to date. And the most favorable is the NASDAQ 100 growth stocks, followed by the small cap index, and then it drops down to emerging or developed markets, emerging markets, S&P 500, government bonds, and at the very last, the Dow. Now, last year, during most of last year, most of these, or nearly all of these, all of the time, were in negative territory. I think they were all in negative territory most of the time. And the one that was down the least was the Dow Jones Industrial Average. It's now on the bottom. So it is up, but it's up the least. So the range that the Dow follows is a much narrower range typically, and you see that here. Conversely, the one that was down the most, and I think it went down as much as 35%, was the NASDAQ 100, which is now up almost 15% for the year. So it's a more volatile index. When the market's going up, it's not surprising to see it surging, and when the market's falling, to see it surging in the wrong direction. So next are the sectors. Again, most of the sectors inside of the S&P 500 are positive over all of their moving averages, 20, 50, 100, and 200-day moving averages. The most favorable sector is retail. That's not surprising. That often happens, followed by consumer discretionary and technology. And the worst sectors year-to-date that are actually negative year-to-date are consumer staples, energy, and healthcare. And those are, again, those were the ones that were the high flyers that were doing amazingly well last year, and they've now sunk to the bottom of the list this year in a very different kind of market environment. The S&P 500, this is a chart, it's a weekly chart showing the moves, the weekly moves of the S&P 500 over the past year. One change in this line represents 1 week. And I drew an arrow at the end of it so you could see the direction, the general direction of the S&P 500, generally in an upward direction. That's also supported by the previous dashboard that I showed you. The growth stocks this is interesting that when this goes up, it shows that the growth stocks are more in favor, and that when it goes down, it shows the value stocks are in favor. And so for a period of 14 months, you can see this largely, except for one big exception last summer, you can see that primarily that value stocks are in favor to this extent, and growth stocks are out of favor to this extent. So even though growth stocks have done very well since the beginning of the year, they last week, you can see at the very end of the chart, slightly going down. So for the entire week, last week, growth stocks were somewhat out of favor. This shows the small cap, and it's a relative chart, just like the previous one, showing small cap index, IWM, Russell 2000, as the numerator and the S&P 500 as the denominator. So for about a year, about the past year, you can see that generally speaking, it's kind of flat, but moving a little bit in an upward direction. And at the end of the chart, the far right, you can see that the small cap is starting to rise. And we saw that on the indexes, the first set of indexes that I showed you, IWM, the small cap Russell 2000 index, has been very favorable, as has the NASDAQ 100. In this case, both indexes are moving up. It's just that the small cap is moving up at a rate that is faster than the S&P 500. This is a 32-month weekly chart of the 20-year government bond ETF, TLT. There are two periods of time in this 32 months where the government bond, it's not a relative chart, it's an absolute chart, where the government bond is moving in a downward direction. You see at the beginning of the chart and toward the end of the chart. As you go to the very end of the chart, you can see that the long-term government bond, TLT, is starting to move up and has crossed up above its 20-period moving average. I don't know if that's really considered strength at this point, but it's at least kind of broken the trend line and is moving slightly in an upward direction, and that's positive for the holders of that ETF or the holders of bonds. Conversely, what that means is that interest rates have been going down if bond prices are going up. This is a 20-month chart showing the move of the dollar, the US dollar, represented by the ETF UUP. You can see that for a long period of time, it moved in an upward direction, but for the past several months, it has begun to decline. But at the very end, last week, it ticked up a little bit. So I don't know that that's the beginning of a trend because, things go up and down quite a bit. It has not, in my opinion, really broken the trend line. So I'd say it's still the dollar is generally moving in a downward direction. Gold, represented by the ETF GLD, is generally at the end of the chart for the past few months, has been moving in an upward direction. But last week it got hit pretty hard. So it came back some correction, but I would still say it's generally moving in an upward direction, and certainly it's above its 20-period moving average. Silver has not done as well. It has come down even sharper than gold has. Generally it's going up, but it's at the very end you can see there is a weakness. At least last week, the last couple of weeks, there was weakness in the price of silver. When I compare the two charts, silver being the numerator, gold being the denominator, it goes up and down a lot. But at the end of the chart, because of it's a relative chart, the weakness of silver to gold, this relative strength shows that silver, it's forcing that relative strength line down relative to each other, silver relative to gold. So I would say that probably has broken the trend line. So that's why I drew a new arrow showing that from a relativity standpoint, silver, at least for right now, is showing weakness relative to gold. They may both be going up or they may be going down, but the relative difference is favoring gold. Bitcoin, represented by the ETF GBTC, which represents Bitcoin, is starting to move up. It doesn't look like a lot, but percentage-wise, that's quite a bit. It's moved up quite a bit, but generally, the longer-term picture is that it, over the past 14 months, has moved in a downward direction. We'll see if this continues on up. My sense is it will, but I don't know that for sure. It's leveled out in the last week or so, but I'd say, generally speaking, it's starting to break the trend line and move up. The volatility index is still very favorable. So the lower this is, the better it is for equities. So it shows low volatility. And if it goes up, particularly above my black line there, starts to move in an upward direction, then it would show that equities are weakening and there is volatility coming into the market. So I'd say this is, everything I've shown you is really mostly a positive indicator, and this being no exception. This is a positive indicator for the market, at least for right now, through Friday. Okay, Asbury Research. Asbury Research does provide 6 metrics, and this shows the data as of Friday. All 6 of their indicators, not unlike what I've shown elsewhere, everything is moving in a positive direction. This is a relativity set of data showing, comparing assets, types of assets to others, or indexes to others. And you can see that, I'll just kind of go through the ones that are where the green bar indicates a level of strength that is higher than, it's a modest level of change if it's a white box, but it's a stronger relative strength if it's a green box. Stocks being more favorable to bonds. High beta stocks are more favorable than low beta stocks or low volatility stocks. Small cap, again based on the data before, small cap being more favorable than large cap. Broad market being more favorable than the Dow, which is the blue chips. Technology being more favorable than the NASDAQ 100, being more favorable than the broad market. Growth stocks for this period of time, the last week, the last month, the last year, or excuse me, last quarter, all 3 periods, growth is favored over value. And emerging markets are more favorable than the U.S. market when measured for the last week, month, and quarter. Corporate bonds are more favorable than government bonds. Both have moved up, but corporate bonds have moved up faster. Very interesting chart. This has changed. If you've watched this over the past few weeks, you know that there were countries all over the world, developed and emerging countries, that were stronger than the U.S. Well, that's changed. Now, the U.S. is stronger than every other country than in the last week. And you've seen that again from some of the data. And every country except Chile for the last month. However, when you go over to the last quarter, most of those countries still are stronger than the U.S. Very few. Chile would be the one exception that is stronger than the U.S. It's not strong enough. The U.S. is not strong enough to even get enough of a green box. So you'd say it's slightly more favorable, but not by a lot. To make that point, here's the chart of the SPY U.S. compared to developed markets, primarily Europe, Japan, South Korea, Australia. When you compare that, you can see that the general direction is favoring other developed markets, primarily Europe and Japan. And however, during the past week, the past couple of weeks, that has started to change, and now the U.S. is becoming stronger than the developed markets. So this is gold and silver. Now, I showed you on the chart for gold and silver that both declined this last week. Well, gold actually had no change for the past week, but silver had a decline of 5.2%. That's quite a bit. So which resulted in the silver, that comparison chart, the relative strength chart, silver being weaker than gold, at least in the short run. So gold is 1932 per ounce, spot price. Premium is on top of that. And silver is at 22.41, spot price. So, yeah, it's one per kid. Have you seen the price of eggs? Okay. Thank you for watching. If you have questions or comments, leave them in the comment section below and I will try to answer them. Thank you.